Welcome, everyone. This is the Insurance Budgeting for 2025 webinar. I am sure many associations have already done their budgeting. Hopefully what you have budgeted will be in line with what we discussed today. If not, at least you have the information. A little bit about myself. I am the CEO of Mackoul Risk Solutions. I've been doing this, it'll be 30 years in February. I have both the certified insurance counselor and chartered property casualty underwriter designations, and my agency specializes in basically real estate, community associations, rental properties, etc. Let's just have a little quick history lesson on insurance. It is cyclical. There are soft markets, which are considered buyer's markets, and then there are hard markets like we are in now, which are considered seller's markets. Insurance companies make money in two ways. First way is underwriting income, which is basically charging enough premium to offset any losses and any expenses. And then what they do besides that is they take that money and they invest it, which is the second way. And typically they invest it in relatively safe investments, although there are some carriers out there who have been taking a little bit of a stance where they're investing in equities, stocks, etc., and have done very well of late. When an insurance company isn't making enough money, a hard market results. Okay. And symptoms of a hard market are one, premium increases. We've all seen that. Two, they become much stricter with their life safety and their other requirements. So all of a sudden they say, well, yeah, we want every building to have hardwired smoke detectors. Insurance companies also, their underwriting criteria becomes more stringent. So technically, it's almost like they don't want to provide as many quotes, and they don't. So on maybe on a normal average building in the middle of Manhattan, there would be 8 carriers who would be willing to quote. Well, maybe there's only 2 now. And so in addition to an increase in premium, fewer quotes generally increases the chances of paying a higher premium. It's all supply and demand. Excuse me. The current hard market began in 2020 with commercial umbrellas being the initial culprit. We'll get into that a little bit later. But since that time, all lines of business have seen a dramatic increase. At a minimum, almost every insured has seen 10 to 20% annual increases for the past 4 years. And some properties, probably those who have issues, again, which we'll get into in a little bit, have probably seen a lot more. Eventually, the insurance companies stop becoming profitable. Okay, so they've been raising their premiums, they increase the premiums enough, they start making money, and they're taking this money again and they're investing it. And so what happens now is their investment income is rising and they decide they want more premium so they can invest it. And this triggers a soft market known as a buyer's market. And either that lowers, they lower their own premiums, or a competitor comes in and provides a lower quote. And so either the competitor lowers your premium, or the incumbent decides they want to hold on to the risk and they lower the premium. Again, supply and demand. And if you look to the right here, this appeared in a publication recently. It kind of goes over the insurance cycle. So victory declared means, okay, we're making money at this point. And then they pivot to growth. Okay, they want to grow now and they want to take that premium volume and they want to invest it. And then you have other carriers who follow. So it's called the fear of missing out. And then so the underwriting they're basically underwriting for the top line, which means they want the revenue. All of a sudden, after they're collecting the revenue because they've lowered their premiums, they start becoming unprofitable. And then reality sets in. You'll see that at the bottom, reality bites, performance problems are recognized. And all of a sudden, they have to start restructuring their portfolio. They go back to basics. They start looking for the underwriting for the bottom line, which is revenue, which is profitability. And that's what happens. So it's cyclical, and it's always been. And as much as it seems like the premium increases is never going to end, at some point they will. But what happens is, again, is one carrier will start lowering their premiums, or a new carrier will come into the market and others will follow. It's Boris Johnson basically said, when the herd moves, it moves. We're going to go into the forecast for each of the lines here: commercial property, general liability, commercial umbrella, D&O, or directors and officers liability, employee dishonesty, also known as crime, fidelity bond, and then cyber liability insurance. Commercial property. For the past 2 years, commercial property insurance rates have been increasing as building limits have been increasing. So I'm sure you've been seeing increases longer than that. Some of it may be attributed to the umbrella, some to the liability, but the last 2 years, the property has really been kind of the culprit. One of the reasons is reinsurance. So reinsurance is insurance for insurance companies. So an insurance company will buy insurance from another company, and it helps keep the market stable because it allows them to have a backup, so they can almost hedge their bets. So, for example, if you have a building that is insured for $100 million, well, your insurance company may not be insuring the whole thing for $100 million. They may only have $50 million, and they're buying the other $50 million and paying a premium for it. Well, what's happened is the last couple of years, reinsurance companies have raised their rates. Once they raise their rates, well, it filters down to the insurance companies. Insurance companies have to raise their rates. Also, the cost of materials and labor has been increasing in the past several years. And that's how you rebuild. And so the insurance companies have been increasing the building limits. However, there's still many buildings that are underinsured. So some insurance companies have been increasing the building limit upon renewal, but many have been doing it on a step-up basis to avoid hardship, which basically means they'll increase the limit over a couple of year period. Most of the time is generally 2 years, but let's say last year they came to you and said, well, you need to increase your building limit from 25 to 40 million. They may have only taken it up to 32 million with the possibility of now increasing it to 40 million this year. So it is possible that you may still be underinsured because you agreed with the insurance company to do it on a step-up basis. Other reasons, the track record, we're seeing more and more construction of new properties. And the truth is, the track record for newly constructed properties and sprinkled buildings, because they are sprinkled at this point, uh, really haven't been favorable. So buildings constructed in the last 5 years may actually be paying more than their identical neighbor right next door, which is exactly the same building, same amount of units, same construction, but they may be paying more simply because the other building has a track record for the insurance company to see. We are also seeing increased water damage deductibles, which are the most common property claims an insurance company sees. So it used to be that you had, let's say, a $5,000 property deductible, and your water damage was the same deductible. A lot of insurance companies have really been splitting that off now, and their water damage deductible is going to be different. And so it may be 10,000, it may be 25,000. I've even seen some buildings that have $100,000 water damage claim. We are also seeing wind deductibles being applied now, and the same. A wind is a covered peril. And so what we used to see is, okay, well, just covered under your property deductible. But now a lot of the insurance companies are starting to add a separate wind deductible, and it's basically a percentage. So although some of them may say, okay, you have a $5,000 property deductible, and some of them may say, we're just going to put a $25,000 or $50,000 wind deductible on it. But some of them are doing, and most of them will do it on a percentage basis. So if you have a $10 million building and they want to apply a 5% wind deductible, well, I mean, now all of a sudden you have a pretty decent deductible, and that may be $500,000. So it varies, but this is what we're seeing in terms of property insurance. Overall, though, we feel that the commercial property sector should be considered more stable in 2025 than in the previous years, especially for buildings who have already seen the increase in their building limit and are insured up to value. Good risk may only see 5 to 9% increasing, and the reason it's usually capped at 9% is the insurance company, by law, if they're admitted in New York, must give a notice uh, that the premium is going to increase by 10% or more. And a lot of times they don't want to do that. And so right now, those risks with favorable loss history, with little to no violations, acceptable electrical systems. What we mean by that is not having fuses in the building or in the apartments. And even if you have circuit breakers, not having what's called Federal Pacific stab lock circuit breakers, which are known to be defective. If you have either one of those, it is not considered acceptable. So if you don't have them, that's acceptable. If you're already insured up to value, um, I would budget 5 to 9% on the property. Some properties, and this may come as a surprise, those that had difficulty in recent years and have ended up in the excess and surplus lines markets, meaning not admitted markets, they may be able to get back to admitted markets now and see an actual reduction in their insurance premiums. Normally, when you end up in these type of markets, they're a necessity, but their premiums are higher and the coverages are not nearly as good as an admitted carrier. And the reason you're there most of the time is because of everything you see right above. Maybe they didn't have favorable loss history. Maybe they had violations. Maybe their electrical was not acceptable, but that has been changed. So if your loss history has become favorable, you've changed the electric, you may actually get into an admitted market and actually see a premium decrease. However, and here's the caveat, Risks that continue to have claims, violations, those who are underinsured are probably going to see more premium increases, and I would start at 20% or higher. General liability continues to be an issue and probably the main issue. There's been an uptick in both the severity and frequency of claims. Let's go over a couple of things here. In New York, this part is specific to New York. New York labor law claim sections 240 and 241 pretty much hold the building owner strictly reliable for construction-related incidents. Uh, this is the only state that still has a law like this. And basically what it is it's an injury to a contractor or contractor's employee. So in theory, if a contractor's employee gets injured, they can't sue their employer because of workers' compensation. Who do they sue? They sue the building owner. And the building owner is almost always held responsible for these claims. And so if you have one of these claims on record, they can tell you you're probably going to be non-renewed by your insurance company, and every other insurance company is probably not going to want to offer a quote, at least the admitted ones, which means you're ending up in that excess and surplus lines market. Your premium will probably increase by 400 or 500%, and that can last for up to 5 years because that's usually what the look back period is for insurance companies. So imagine your premium goes from 100,000 to 500,000. That's a $400,000 increase. Well, if that lasts 5 years, you've now seen $2 million worth of insurance premiums increased. This has caused insurance companies to become very diligent, requiring their insurers to have proper risk transfer when hiring a contractor. Proper risk transfer is making sure they have insurance, making sure that in the event of a claim where the association or the building owner is named in a lawsuit because of an injury to a contractor's employee, that the insurance company for this association or property owner is able to put it and tender it back to the contractor's insurance company. So the insurance companies have become very, very diligent about that and very strict about that. And if the insureds don't comply, the insurance company can and often will non-renew the insurance policy, and we're seeing that on a regular basis. There's been a rise in frivolous slip and fall claims. A slip and fall claim involves someone alleging they were injured when they fell on the sidewalk with a crack or defect. They sue the property owner, basically as adjacent to the sidewalk, for negligence. Now, in New York City, the property owners are required to maintain a sidewalk outside their buildings and could be held liable if someone is injured on the sidewalk. This happens everywhere, though, but in New York, the laws, once again, are a little bit more stricter than most states. And with insurance companies are seeing more and more of these claims. Not only are they seeing more and more of these claims, but according to the National Insurance Crime Bureau, New York City is the #1 city in the country for questionable slip and fall claims. And fake claims are causing insurance premiums to rise for building owners. And let's talk a little bit more about frivolous or whether they're not frivolous, but um, we're seeing, or I should say, the insurance companies are seeing more and more claims where someone was already injured previously, and yes, they did slip and fall, and it is not frivolous, but they're the insurance companies paying for injuries that were there previously. Not all slip and fall claims are frivolous, but some of them are not really the responsibility of the property owner. The insurance companies are seeing more and more claims where someone is on their cell phone, and I'm guilty of doing it myself, of reading something or on their phone, not paying attention, they slip and fall. Well, the insurance company and the property owner, the ones who are held responsible, the insurance company ends up paying out a claim, despite the fact that really what was their negligence on this part? Probably nothing, but it doesn't make much of a difference. To offset this, several insurance companies are discussing requiring their insureds to install closed circuit TVs. And some buildings already have it, but the technology now is much, much better than it used to be. And so a lot of the older systems really only had recordings for 30 days and then they were wiped out at that point. Well, a claim can come up 18 months later and there's no proof at that point. So more and more insurance companies are contemplating requiring their insureds to install the new technology, which could back up these recordings in the cloud for anywhere from a year to 10 years, 3 years probably being the ideal time because of different laws in terms of how much time you have to submit claims. And what they're doing is possibly giving a discount to the insured to on their insurance premiums to install them. So these are things you're going to start to see to offset some of these claims. Um, but there has been, as I mentioned, both the severity and the frequency, and we're going to talk about social inflation in a second, but this is where it comes into effect. Now, if most of this is New York related, we've talked about the labor laws, we've talked about the sidewalk laws. If you're located in a state that is not New Jersey, New York, New Jersey, or across the country, you probably think, well, why are we paying an increase in the prices and the premiums? Many of the same insurance companies that write in New York are the same insurance companies that write in other states. So if you have an insurance company that writes in New York, well, they might write in Massachusetts, they might write in Illinois, they might write in Texas. And so if the results are poor here and they're unprofitable in one area, that's going to affect the rates in all areas. Now, it's not just New York. We're not just picking on New York here, because if you go into, there was a statistic that was in a publication the other day. It says Texas has logged 186 $1 billion disasters since 1980. That's by far the most in the country. Georgia is the next closest at 129. So, although on the liability side, we're picking on New York, uh, the property side is probably affected. New York is affected by what's going on in other states. So that is a reason why insurance companies are, it's not just your state, it's not just your building. What they're doing is they have a track to run on for the entire, for all the business that they write. Now, social inflation has become an issue, and probably the biggest issue, and that is defined as increased awards by juries for numerous reasons. It has caused payments and settlements to increase drastically and dramatically. And some of these reasons may simply be uh, you have people on these juries who are saying, okay, these insurance companies have deeper pockets. Maybe a generational thing where you have the younger generation who uh, really have the attitude that the insurance company is responsible and they have the deep pockets. So over the last several years, the judgments have increased dramatically. And I'm just going to give you some examples. And these are not related to property owners, basically, although one is, but we're starting to see um, more of these judgments called nuclear judgments. We're going to get into a second, where they're astronomical. There was one in the publication the other day about a woman who was terminated from her job because she did not get the COVID vaccine. Long story short, she sued and she was awarded $12 million. Only about $1 million of that was, or 1.7 of that was lost pay, and a little bit more of that was pain and suffering. But it ended up being basically a $12 million claim. Uh, I'm not involved. I have no idea about it, but we're seeing more and more of those suits. I was talking with an insurance company executive yesterday, and he mentioned a lawsuit that they were on where someone was injured doing work. He was on a scaffold and doing work for a voluntary fire department, fell, and he was injured. Now, this gentleman had a history of injuries. He was probably a contractor for many long time, had many injuries. And so they basically ended up paying about $10 million simply because it went to a jury, and the jury decided that these injuries were detrimental. And the fact is, they didn't take into consideration that he had many of these injuries before. So social inflation is real, and that is the biggest issue the insurance companies are facing these days. On the forecast, on the low end, I would say insured should budget an increase of 5 to 9% again. But I'm going to use the but. Properties with issues like unfavorable claim history, and that could be either one large loss or several small losses. Any open claims in excess of 25,000. So if you have a claim on record, someone slipped and fell, and they were paid something, and it's been closed out, that's a lot better than an open claim, because the open claim could be reserved at 50,000. And when I say reserved, that means that's what the insurance company expects basically to pay in expenses and judgments. Well, that 50,000 could change very quickly to $1 million, and that happens based on what's going on in the lawsuit, injuries, medical, etc. So an open claim is going to be an issue in excess of 25,000. Any labor law claim on record, forget it. Even if it's closed, if there was a large payment, if it's open, it's almost impossible to get a decent insurance at a decent price. And anything with open violations should start budgeting at 20% at a minimum. And again, depending on what issues you have, it could be a lot more. Commercial umbrella. Almost every property, whether it's co-op, condo, homeowners association, or rental property that had an umbrella several years had been insured in a risk purchasing group, also known as an RPG. Up until about 2020, 2021, what an RPG is basically it's made up of various carriers who make up the various layers. So if you had a $100 million umbrella, typically in 2020 or 2021, you would have had at least four carriers providing different layers, and sometimes more. So you might have had Chubb, who was on the first 25 million, AIG on 26 to 50, another one on 51 to 75, and then there was a fourth one on 76 to 100. And sometimes there were six or eight carriers involved. Well, what happened basically is because of these increased claims and uptick in social inflation, more and more suits started to pierce the umbrella. So they exhausted the underlying limit and began piercing the umbrella. And so this caused these RPGs to pull out of the marketplace or reduce the amount of coverage that can be offered. Pretty much everyone had high limits from 25 million up to 200 million on the high end at very low premiums up until about 2020. What we're seeing now is we continue to see more and more insureds now with a 5 million, or if they're lucky, at $10 million, because not only have the high limit or all limit umbrellas skyrocketed in premium, but there are far fewer programs now that can write these umbrellas, and many insureds don't qualify for one reason or another for the few that still remain. Uh, these programs, as I just mentioned, are seeing more and more suits that are exhausting the underlying limit in the general liability or D&O policies, and they're piercing the umbrella. So that's why rates have gone up and limits have gone down. Here are the culprits: labor law claims in New York. In New York, many of these have started going into the seven figures the last several years. I had lunch about 5 years ago with one of the heads of the insurance company, and he had said at that point, this is 5 years ago, and it's gotten worse since then, that they had seen more claims that exhausted their underlying $1 million limit in the last 7 years than they had seen in the prior 45 years of the insurance company's history. So that was 5 years ago, and it's gotten worse since then. Social inflation is another culprit, and probably the main culprit, which applies to all states. Again, that is an increase in judgments due to one reason or another, and that is really what the insurance companies are facing these days. So a lot of the times they are choosing to settle a lawsuit rather than go to court, because they know if I settle, I can settle for this amount of money. Then sometimes it's better to know. They say know the devil you know, and not the one you don't. Well, it's basically here. So what's happening is there's more and more claims on record because they're settling rather than taking the chance to go to court and face juries. Culprit on this, again, nuclear judgments, which are typically jury awards that are more than $10 million or significantly larger than was expected for the case. Juries in the U.S. have awarded more than $14.5 billion in nuclear judgments in 2023. That's a 15-year high. We'll see at the end of this year if we are going to beat that. That's not a stat we want to beat, but I am sure we are probably pretty close to it. More often, insureds are only eligible for an umbrella with the same carrier that is providing underlying general liability insurance. So the good news is that they're a solid option, and they often don't exclude construction labor law claims, which is absolutely detrimental in New York, and you need to have that coverage in most instances, whereas many carriers do. But the bad news is sometimes these markets will not provide excess coverage over your D&O policy, and sometimes and often they are quite costly. And even if you're lucky and are eligible for one of the RPG umbrellas who are still remaining, you are still going to see an increase in premium. And more than likely, you will not get your new quote or renewal quote until a few days before, as these programs are overloaded with submissions. I mean, if you think about it, if there's, I don't know how many, there's somewhat along the lines of 40,000 community associations, and a lot of these programs are writing in several different states. Well, they are overloaded with submissions from everyone. Overall premiums for commercial umbrellas are still increasing. On the forecast, I would say 9% on the low end. But here's one caveat: if you have the two reasons why you're typically not eligible for one of the RPGs is either violations or unfavorable loss history. Now that could change. Violations can be closed, losses fall off record. So there is a possibility that if you don't have violations anymore, if you've reduced them, or if you've had some losses that were now probably 6 or 7 years old, you may be able to get back into one of these RPGs if you're not currently in there. So it's worth speaking to your broker and seeing if you can get back into one of these RPGs. Like general liability insurance, there's been an uptick in claims over the past few years. People continue to sue. And D&O carriers, which are typically not profitable in several larger habitational states like New York, New Jersey, Florida, California, and Texas, began raising their rates by 10 to 20% last year. I don't see that changing. Okay. Those states have not gotten more profitable. Many of the other states are the ones that are, and they really kind of offset the losses here. But I would expect that you would pay at least a 10 to 20% increase on your D&O premium. The good thing is the premiums aren't that large. So you may have a $3,000 D&O premium, 10% may only be $300 or $600 on the high end. So that is the good news. But I would budget an increase there. Employee dishonesty, crime, fidelity insurance. Uh, they rates were pretty stable last year, and they have been pretty stable. I'm going to say they're going to be stable for 2025. You may see a slight increase in premium because most of the fidelity bond employee dishonesty limits are based upon 3 months of maintenance. And I am sure you have probably seen maintenance increases, which is causing the need for more fidelity bond coverage. So you may see a slight premium increase because of that. But again, these premiums are relatively small. They could be $600, they could be $800. So even if you're taking a 20% increase, it's not that bad. I would probably budget 5% unless your maintenance has really gone up astronomically. And cyber liability insurance is probably the fastest growing insurance policy, not just in property, for property owners, but for every industry. While the premium for a co-op or condo is relatively low, we're starting to see increase in this area as well, thanks to what's called social engineering claims, and there's been an increase in them. And so basically, the liability covers a couple of different areas. One being if personal information is breached. The second one, and the most popular one for several years, was hackers were freezing or locking out people's computer systems and charging a ransom. And so typically cyber policies used to, those are the two areas they used to cover. Well, social engineering is kind of new in the last couple of years. And what that is basically you're being duped into paying the hackers. They're not stealing your money. These are bad actors, and you are voluntarily paying them. And how is that? Well, these claims typically result because a hacker will get into your system. They'll send an email. You click on a phishing link. You don't think anything of it. Typically, when that used to happen, they used to block your system, and then that's how they would hold the ransom. Well, now what they're doing is they're dwelling on your computer, basically, and they're watching everything that comes in. They see your email. They see that when you open up an email, it has an invoice attached to it. So now what they're doing, and this has happened quite a bit recently, is they are dwelling on the person's computer. They see an invoice come in from ABC contractors, let's say. They dummy up the invoice, change it, and add different banking information, and they send it. And what happens now is the person who pays the bill says, okay, I know ABC contracting, and they send off this payment. Well, what they're doing again is they're not, the bad actor isn't stealing the money. You just paid them voluntarily, and that's called social inflation. And so cyber policies have now started to increase this coverage, and they're increasing the premium, which is justifiably so. Or if they didn't include it before, they're allowing them either to the policies are starting to offer this coverage on an overall basis, or they're allowing insureds to start increasing and adding this coverage. I would budget at a minimum 10 to 20% in this area. Again, the premium has been relatively low for associations. You may on the low end be paying $1,000. You may be paying $2,000 or $3,000. A 10% increase isn't too bad, but it is a necessity, and that is it is something that's probably going to continue for a few years. Overall, I would suggest budgeting a minimum of 10 to 15% in your insurance budget, which is much less than in previous years. But it all boils down to your building. And like we discussed before, in terms of some of the issues there may be properties that actually see a decrease because they've had a rough go for several years and now they're a better risk because claims have either been closed. Again, we've talked about open claims and now maybe they get closed. Claims have fallen outside the 5-year window. So if you had a claim, let's say you 6 years ago, well, 3 years ago when you were marketing your insurance, it was on record. Now it's fallen outside that window, and that will make you a better risk. Or violations have been closed out. So you have a lot of property owners and property managers who have been working to close out violations, which weren't nearly as important 5 or 6 years ago. The insurance companies didn't really factor them in as much as they do back then. Now, so property managers and property owners are taking these into consideration. And so if they've been closed, that would definitely make it a bit more of an attractive risk. So again, I would say at a minimum, I'd be budgeting 10 to 15%. And if you feel you have problems, and you will know, have dialogue with your broker, and if you discuss the claims and violations and electrical issues, you will know if you can fall into that good building range of 5 to 9%, maybe the average range of 10 to 15, or if your building has problems, you budget a lot. How can you offset the premium increases? One, raise your deductible. Okay. Not only will that result in a credit lowering the insurance premium, but it restricts you from submitting the smaller claims. Claim frequency is a lot worse than severity. What I tell people most of the time, it's not that $100,000 fire that gets you into trouble. It's the 6 or 7 small burst pipes that do. Because the insurance company says, okay, well, I think we have a plumbing issue here. And although we haven't paid out a lot of money yet, we're bound to do so. And on they feel the same way on the liability side, even though there's no deductible there. The frequency with claims there is also worse than, if you have one slip and fall. Uh, Fine. If you have 5, now they're wondering, well, are the sidewalks not in good condition? Is the super not getting out there and salting when after it's snow and people slipping on the ice? So again, frequency is normally going to be a lot worse than severity. As I mentioned earlier, that the most common claim on the property side is water damage. Excuse me. More and more companies are out there who will install water monitors or sensors. Some of them are really good ones in terms of that they'll pick up leaks that are going on inside the walls. Some of them are just sensors that are under the sink or behind the toilet, and they'll pick up only after the fact that water has been leaking. So they're not going to catch water damage issues, but they can catch some of them. It's worth looking into. Is if you can put even one claim, it's worth the money. There's several companies out there. We're just mentioning Pro Century because that is one that we have worked with, but I would take the time to do a little research and see about installing these sensors because in the long run, they will reduce the claims, but insurance companies at some point are going to start requiring these. Also, as you mentioned earlier, install closed circuit TV cameras. Not only can you possibly get a credit on your insurance, but these systems can help also throw out or drastically reduce a claim. Many times, an insurance company will settle with a claimant because there is little to no proof or evidence to defend the case. So, I mentioned before, they'd rather settle a lot of the times than go to court. Well, with these closed circuit TV cameras, that's evidence right there. I mean, there's been plenty of times where there was one instance where there was a group of people who were going from property to property, were inspecting the sidewalk, and then it was seen at one place who had closed circuit TV camera where the gentleman just lied down on the floor, basically said he was injured, and then sued. And it came into play that, okay, well, there's video cameras here, and they picked this up, and they were able to get this thrown out. But it was, you have some of these frivolous and fraudulent claims where you have doctors who are involved, you have unnecessary surgery being performed. Okay, well, now all of a sudden that's a 250,000 or $1 million claim that's on record. So think about installing closed circuit TV. Require unit owners to maintain homeowners insurance. All too often, an uninsured owner is damaged. And since they have no recourse, they have no insurance. What do? They sue the board of the building. Okay. And that results in a claim on record. Or the insurance company for the building ends up paying to put the unit back to its original condition, minus the improvements, which is their responsibility. Whereas the homeowner's carrier may have had some responsibility here, but since there's no insurance, it falls on the building. And depending on what state you're located in, your owners may be responsible for the association's deductible. In New Jersey, the Condominium Act designates that affected owners are responsible for a proportion of the deductible for the condominium, and so insurance coverage will pay for that. Plus, owners having insurance that includes a coverage called the loss assessment allows the association to go with a higher deductible and not have an out-of-pocket cost. So, loss assessment basically is the coverage in a homeowner's policy or condo or co-op that says if in two things, either the peril that is covered under the HO6, the association did not have enough coverage for, and they assess the owners. This will pick up the coverage. Or also, in the instance where the association has a deductible for a covered peril, they can assess the owners, and it would be picked up once a year on the insurance policy out of the owner's insurance policy. And so, if you have an association that has it requires insurance, there's got to be a way to monitor it. We're proud to say that we have a department that monitors insurance for associations. Board isn't going to do it. A lot of times put on the property manager. It's a tremendous amount of work. They're not going to do it correctly because their job is to manage the building, not monitor insurance. So we are doing it. I'm sure other places will start doing it. So if you require insurance, have someone monitor it so that way you know who has insurance and that they meet all the requirements of the association. And have your broker review contractors before you hire them. Uh, if they won't, then find a new broker. So you should be asking your insurance broker to review the insurance policy for a contractor before you hire them. The largest liability claims in New York are related to injury to contractors. Uh, and so, as I mentioned before, the insurance companies are requiring that the contractors have proper insurance so they can transfer the risk back to them. Well, what we do and other brokers should be doing as well is reviewing the insurance policy and the contract for the contractor you're hiring. Okay, we do that for all of our clients. We review the policy, review the contract, review the certificate of insurance. This is critical because as the insurance marketplace for contractors isn't that great right now either. And so it is a challenge for them to write the contractors. And so what happens a lot of the time is the contractors will cut corners to have a lower premium because they simply can't afford the insurance policy rates that the insurance company is charging. Now that leads to claims that the insurance company for the contract, excuse me, insurance company for the association can't transfer it back to the contractor. So now it sits on the property owner's loss history. So those are your ways basically to reduce your insurance premiums. All right, looks like we have a question here. How much advance notice must an insurance company give if they are raising rates more than 10%? Does this notice requirement apply to umbrella insurance policies? I'll start with the second question. Yes, it applies to all insurance policies. And typically, depending on the state, it varies. But in New York, they have to give 60 days notice if they are going to increase your premiums by 10% or more. Now, that being said, that's admitted insurance companies must follow the rules and requirements of the Department of Financial Services or the insurance department. If an insurance company is not admitted, they technically don't have to follow those rules, although most will do so. They don't necessarily have to give you 60 days notice. So it could be different. They may even give you less notice because, again, they are not admitted and they don't have to follow the same rules as admitted companies. But if you're an admitted company, they are required to give you 60 days notice in New York. And I believe it is 30 days notice in New Jersey. Other states may have different requirements.